Have you ever been confused about the terms used in the trading space? Well, today we will be covering the most important trading terms that you need to know. So let's get started. Being long is to buy the market and expecting to sell it later at a higher price for a profit. You are taking a position where you are making profit when the market goes up. The next term is short or short selling. People are often confused about how this works, but what you really need to know is that it is taking a position in the market where you profit when the price drops. Bullish or bearish. Being bullish is having a bias that the market is going to go higher. So for example, this is the chart of the S&P, and you can say I'm bullish on the S&P since time immemorial. Fun fact is that bulls attack from the bottom up. On the other hand, being bearish is a bias that the market is looking to hit lower. So here's the same chart as previously, just that this time, person B has a bearish bias on the market saying,
I'm currently bearish on stocks because of COVID.
Well, oops. Each person has their own biases, but doesn't mean that their bias is correct according to the market. And the fun fact here is that bears attacks from the top down, bid and ask. We've all heard of the concept of buy low and sell high. So the bid being the highest price that the buyers are willing to buy at, in this case is 4574.99, and the ask is the lowest price that people are willing to sell at, which is 4575.58. This gap in price is called the spread, which leads on to the next term that you need to know. This spread is calculated as the difference between the ask and the bid price, which gives a total spread of 0.59. Stop loss, stop, or SL. A stop loss is an order to close your position when a certain price is reached, usually for a loss. So let's say you entered long here. You place your stop a couple of points lower marked by the bottom of the pink zone, and with stops in this situation, you manage to prevent yourself from losing a large amount as the market went much lower. Conversely, we have the target, take profit, or TP. This is an order to close your position at a profit when a certain price is reached. So let's say we shorted the market here, stop a couple of points above, and a take profit much lower. In this case, as the market tapped our targets, we will be taken out of the trade for a profit. There's three most common order types, which will be classified into pending orders and instant orders. Limit orders and stop orders are pending orders, while market orders are instant orders. Pending orders are when the trader is more particular about the entry price, whereas market orders just want to get filled. I don't care what the price is, just get me in. It's usually used for time-sensitive scenarios. Here's a limit order example. Say we want to go long this market, and at this time the market was trading up here. But you want a better price. So what you do, you place a limit order below current market price, and you wait for the market to come back down. You get triggered after price came to your entry point, and now you're buying the market from that point. A stop order example from the same chart. Again, we are looking to go long, but this time we want the market to start heading in our direction first before we get in on the trade. So as the market was heading back down over at this point, we decided to put a stop order which is above the market price, so that if the market can change direction and we head up, we will get triggered in. With stop orders, you actually enter at a worse price compared to limit orders, but you enter with the market momentum. A market order is when you just want to get in no matter the price. So for example, in this instance, if you wanted to buy, you would be buying at the ask price, which is the red line. And for selling, you would be selling at the blue dotted line, which is the bid price. Scaling in and scaling out. Scaling in is when you're entering bit by bit into your position at different times. So for example here, we wanted to go long, we took our first buys, market went up higher, we take more buys. As it's looking good, we take even more buys. And conversely, scaling out is when you're exiting your trade bit by bit, not all at once. Once the market started to head up higher, we took our first sell to cover some profit. And as it impulsed higher, we decided to take more positions off. So scaling in is usually done by traders who prefer to start small and build a position as the trade looks more favorable. As for scaling out, since we never know how far a trade could really go, traders do close some of their profits as certain price targets are reached while holding some for more profit. Slippage. Slippage is when you're filled at a different price from where you intended to trade at. This commonly happens during high volatile and low liquidity periods such as news releases. So in this example, the intended price to execute was at 1.15581, which is the lower price shown. But instead, half of the position was filled at the intended price, whereas the other half of the position was filled 1 pip higher. We'll go on to pips in the next part. Next is liquidity. I'll explain it to you by showing you two examples. liquid instrument on the left and an illiquid instrument on the right. In the center column, we have the price of the instrument, and beside the prices, we have the number of shares available to be traded at each individual price level. So we see on the liquid instrument on the left, we see that there are many shares available at each individual price level, and we see that the spread is also pretty small at 0.2. This means that if a trader wanted to trade with a lot of money, they would most likely be able to enter and exit at the price and at the size that they want, because there are many people who want to buy from them or sell to them. For the illiquid instrument on the right, we see that there's sparse volume on each price, the spread will be larger, and a large trader may not be able to get all their orders filled, since there are not many shares to be bought or sold to in the first place. They may also have trouble exiting their positions because there isn't enough liquidity. Nobody is trading with them. Commissions. It is the cost charged by brokers to place a trade. Costs are usually proportional to the size of the trade. The larger the size, the more commissions you pay. Some brokers offer commission-free accounts, but there's a catch though. They usually increase the spread and get paid that way. In this case, commissions are hidden. You don't really see it, but you're actually paying for it. And the final term for today we have is leverage. Leverage is controlling a larger amount of money using a smaller amount. So let's take an example. Let's say we had $1,000 to trade or invest, and one scenario is you take on 100 to 1 leverage, whereas in the other scenario you have no leverage. The 100 to 1 leverage gives you 100 times your initial deposit, which means that you control up to $100,000 worth. Whereas no leverage means you only have your initial balance, which is 1,000. This consequently means, for the leverage scenario, you would be able to purchase up to 1,000 shares at $100 each, versus 10 shares unleveraged. This shows that leverage is actually a double-edged sword. It magnifies both gains and losses. If you use it well, it can scale you up very quickly, but if you use it irresponsibly, you can get scaled down real quick. Leverage is actually quite misunderstood by the trading community. Actually, if you know how to use it, leverage is nothing to be feared about. It's quite useful if you use it responsibly. So let's say you have $10,000 in trading funds, and you're planning to risk $100 per trade. So instead of depositing $10,000 into the brokerage, you can instead deposit $2,000 into your brokerage and place the balance of $8,000 into your high-yield savings account. This way, you reduce the broker risk in case the broker goes bust, and you let the money work for you instead of letting it sit idly in your brokerage. With a higher amount of leverage, your $2,000 deposited would still be able to control enough money to trade with the intended $100 risk per trade. So there we have it. If you enjoyed this, don't forget to smash the like button, share it with your friends who might find it useful, and subscribe for part 2 of this video. Leave a comment below to let me know if you learned something, and I'll catch you all in the next one.